Hello everybody, welcome back to the channel. This is your host OG John here, and I need you to stop everything you're doing right now, because while you were sleeping, while you were checking your portfolio, while you were reading headlines about silver dropping 4.7% today, something just happened at the COMEX that changes everything, and not a single mainstream outlet is reporting it. Silver is trading at $78 per ounce as I record this, down from yesterday's close of $81.88, a 4.7% drop in a single session. And right now, every retail trader, every casual investor, every person who bought silver above $100 is staring at their screen thinking the same thing. Is this over? Is the rally dead? Was this whole thing a trap? And the answer is yes, it is a trap, but not the kind they think. Because while everyone is watching the price fall, COMEX registered silver inventory just crossed below 100 million ounces. That has not happened since we started tracking this crisis, and we are now exactly 16 days away from February 27th. First notice day for March deliveries, the most critical delivery month the silver market has faced since 1980, and the setup that is forming right now underneath the surface, invisible to anyone who only watches price, is the kind of setup that precedes the most violent moves in commodity market history. If you're watching this channel, you know I don't do hype, I don't do fear, I do numbers, and today's numbers are telling a very specific story that I'm going to walk you through piece by piece. If this analysis helps you see what's actually happening behind the curtain, hit subscribe and drop OG John AG in the comments. 75% of you watching this right now are not subscribed. That engagement is the only thing keeping this content coming. And what I'm about to tell you is the kind of content that needs to keep coming. So let's start with what everyone can see. Silver at $78, down 35.5% from the January 29th all-time high of $121. But still up 22% from the February 5th crash low of $63.90, and still up 144% from where it was a year ago, 144% in 12 months. And people are panicking because of a 4% pullback. This is silver. This is what it does. It terrifies you on the way down so it can make you rich on the way up. But only if you understand what's happening beneath the price. And what's happening beneath the price right now is something I have never seen before. Gold is sitting around 5,300. The gold to silver ratio just widened to 64.5 to 1. At the January peak, that ratio was 30 to 1. Now I need you to understand something about this ratio because it contains a mathematical truth that most people overlook. If gold simply holds at $5,000 and this ratio compresses back to 50 to 1, which is not aggressive, which is not even historically tight, silver trades at $100 per ounce. That's not a prediction, that's arithmetic. And every time this ratio stretches wide like it is now, it creates a coiled spring. The wider it goes, the more violent the snapback. Bitcoin, meanwhile, is at 69,900, down 3.1% today. And I've told you this before. Watch Bitcoin. Below 65,000 and silver is in trouble. Above 75,000 and we're in the clear. Right now, we're sitting in the exact middle of that range. The danger zone. Bitcoin is leading and silver is following. That correlation is still active, and where Bitcoin goes this week will determine whether silver finds a floor at 78 or whether we test levels that will make a lot of people very uncomfortable. But here's the thing about uncomfortable. Uncomfortable is where the money is made, and what just happened at the COMEX is the most uncomfortable data point I've seen in this entire cycle. COMEX registered silver inventory, the metal that is physically tagged, allocated, and available for delivery, just dropped below 100 million ounces. Let me put that in context for you. In October 2025, 4 months ago, registered inventory stood at 167.7 million ounces. Today it's approximately 100 to 103 million, depending on the source and exact timing of the report. That is a 40% decline in 4 months. 40% of deliverable silver gone from COMEX vaults in 120 days. The current drainage rate is 785,000 ounces per day. If that rate continues for 16 more days until February 27th, we will have 87 to 90 million ounces of registered inventory when March 1st notice day arrives. And the March contract currently holds open interest representing 425 to 455 million ounces of theoretical delivery obligations, 455 million ounces of claims against 87 to 90 million ounces of available metal, a 4.3 to 1 mismatch. And before you say what everyone always says, that most futures contracts don't go to delivery, that typically 2 to 5% stand, that the COMEX could handle 8.5 to 22 million ounces of delivery without breaking a sweat, let me tell you what February just showed us. February deliveries are running at a 98% delivery rate. 98. 18.72 million ounces delivered from 19.11 million ounces of open interest. This is not a futures market in any recognizable sense of the word. This is a physical allocation mechanism. Entities are standing for delivery not to trade, not to speculate, but to take possession of real metal, because they don't trust that the metal will be there if they wait. If March follows February's pattern, and there is no structural reason to believe it won't, we're looking at delivery demands of 200 to 300 million ounces against 87 to 103 million ounces available. I want you to sit with that number. 200 to 300 million ounces demanded from a vault that holds less than 100. The math doesn't work, and the market knows it. Which brings us to the question that matters more than any price on any screen. If the math doesn't work, what happens next? But before I answer that, I need you to understand why silver is falling right now. Because the answer to that question is the key to understanding everything that comes next. And it's the part that almost everyone gets wrong. Silver is falling because this is how traps work. When silver was at $121, everyone was bullish. Retail was piling in. Margin traders were leveraged to the hilt. Speculators were euphoric. Social media was full of rocket emojis and moon predictions. That is not when squeezes happen. Squeezes happen when the weak hands have been shaken out, when sentiment turns bearish, when people start saying the rally is over, when the last overleveraged trader gets liquidated and swears off silver forever. That's when the conditions are perfect. Look at what created this sell-off. 6 consecutive margin hikes from the CME, each one designed to force leveraged longs to liquidate. Kevin Wersch's nomination as Fed chair created a hawkish narrative that spooked rate-sensitive trades. Chinese speculators unwound positions before Lunar New Year. These are mechanical factors, technical factors. Not one of them has anything to do with the supply and demand fundamentals of physical silver, not one. But while the price is falling, while retail is panicking, while the headlines scream about silver crashing, look at what the institutions are doing. Look at what smart money is doing when they think nobody's paying attention. In a single day in early February, the SLV ETF recorded an inflow of 1,023 tons. That's 32.9 million ounces in one day, the third largest single-day inflow in SLV's entire history. PSLV has added 10 million ounces since November and doubled their equity program to $2 billion on January 20th. Institutions do not buy when price is rising and everyone is excited. Institutions buy when price is falling and everyone is terrified. That is what is happening right now. The weak hands are selling to the strong hands. The leveraged speculators are being replaced by patient accumulators. And when the accumulation is complete, when the last weak hand has been shaken out, when the vaults are drained and the paper is clean, that's when the real move begins, and we are very, very close to that point. Now let me show you what the East is telling us while the West panics. The Shanghai premium is holding. The latest Shanghai close was $81.55 per ounce on February 6th. Western spot at that moment was $72. That's a 13.7% premium. During the crash peak on February 2nd, that premium exploded to 29%. When you add China's 13% VAT for physical withdrawal, the effective wholesale premium reached 45.8%. Physical silver in China was nearly 50% more expensive than paper silver in New York, while New York paper was in freefall. And today, even as Western prices continue to drop, that premium structure has not collapsed. It's compressed slightly, but it's still there, 13 to 14%, still holding. That tells you something critical. The physical market and the paper market are operating in two completely different realities. And China's not just paying premiums, they're locking down supply. On January 1st, China implemented export restrictions limiting silver exports to just 44 qualified companies. They have reclassified silver as a strategic material, not a commodity. A strategic material, the same classification they give to rare earths and critical minerals that they consider essential to national security. SHFE warehouse stocks are sitting at 423 tons, near decade lows. When the world's largest industrial consumer of silver is restricting exports, maintaining double-digit premiums over Western prices, and draining their own warehouses, that is not a market that is winding down. That is a market that is gearing up for something. For the 70% of you who are long-term physical stackers, I need you to hear this clearly. Today's price action changes nothing about your thesis. If anything, it strengthens it. You are watching the paper price fall while the physical world tells a completely opposite story. American silver eagles are still selling for $95 to $165 per coin. That's a 22 to 110% premium over spot. Normal premiums are $5 to $8. The U.S. Mint still has not released 2026 silver eagles. They're on pre-sale for late February. Dealers are backlogged weeks deep. APMEX's CEO went on record saying the market is under real strain. The exchange for physical spread on 1,000-ounce bars has widened to $1.10 per ounce. Normal spread is 25 cents, a 4 times increase. Silver lease rates have exploded from 0.3% to 8% annualized, 16 times higher. Lease rates only spike like this when holders of physical silver are terrified of lending it out because they don't believe they'll get it back. You are stacking more ounces at lower paper prices while every single physical market indicator screams scarcity. This is not a contradiction. This is the setup. And it's the exact same setup that has preceded every major repricing in silver's history. The structural deficit is in its 5th consecutive year. Cumulative shortfall of 820 to 900 million ounces. Mine supply physically cannot respond because 70 to 80% of silver is a byproduct of other mining. You cannot turn on silver mines that don't exist. And industrial demand isn't slowing down, it's accelerating. Solar panels, electric vehicles, 5G infrastructure, AI data centers, military applications. Over 50% of annual silver supply goes to industrial uses that don't care what the future's price is doing. Factories don't stop buying silver because a hedge fund in Connecticut is liquidating paper contracts. For the traders, here's your technical roadmap. We're testing support at 72 to 73. That's been the stabilization zone over the past week. Below that, 69 to 70 is major support. Break 69 and we retest the 64 crash low. On the upside, 81 to 82 is now resistance. We just got rejected from that level today. Above that, 85 to 88 is the critical zone. Reclaim 85 with volume and we're back in the game. The 50-day moving average is at 75.65. We're currently below it. The 20-day is at 93, which is overhead resistance. The 200-day is at 49.13, confirming the long-term bull trend remains completely intact. RSI on the daily is at 42, neutral but weakening. MACD still showing a buy signal at 8.96, but momentum is fading. Williams %R at negative 100, deeply oversold. Open interest is at 143,180 contracts, down 8.6%. That's capitulation. Weak hands flushed. The trade setup is clear. 72 to 73 is your line in the sand. Hold it and we bounce back to 82 to 85. Break it and we probably see 69. The big move, the real move, comes when we either break above 88 or break below 69. Until then, we are coiling in a range. And coiling in a range after a 36% crash with the fundamentals I just described is not consolidation. It's compression before an explosion. Now I need to talk about Friday, because Friday might be the most important single data point between now and February 27th, February 13th. Friday at 8:30 a.m. Eastern, the January CPI report drops. This was originally scheduled for February 11th, but got delayed due to the government shutdown. Markets are calling it Inflation's Friday the 13th, and the name is appropriate because this number is going to kill one narrative and birth another. Consensus expects 2.5 to 2.6% headline inflation year over year, down from 2.7 in December. Core CPI expected to rise 0.3% month over month. This is the first inflation test of 2026, and it arrives at the worst possible time for people trying to maintain the hawkish narrative. Here's why. If CPI comes in hot, above 0.3% month over month, the dollar rallies. Rate cut expectations get pushed back. Silver takes a short-term hit. We could see 75 or lower. That's the bear case for this week. But if CPI comes in soft, at or below expectations, the rate cut narrative strengthens immediately. The dollar weakens. And precious metals catch a bid that could accelerate directly into the March delivery window. And here's what's important. The underlying economic data already supports the soft landing case. ADP payrolls at 22,000, JOLTS job openings at 6.54 million, jobless claims at 231,000. Markets have already priced in 58 basis points of cuts for 2026 with the first cut expected in June. The Fed held at 350 to 375 with 2 members already favoring cuts. The labor market is softening. If CPI confirms that inflation is cooling while employment weakens, that is the green light for precious metals. That is the scenario that takes the handcuffs off gold and silver, heading into the most critical delivery month in decades. The key is positioning before the number prints, not after. By the time 8:31 rolls around on Friday morning, it's too late. You're either positioned or you're chasing. And every single thread I've laid out today converges on one date, February 27th, 16 days away. First notice day for March COMEX deliveries. This is the main event. Everything else between now and then is noise. Here's what happens on that day. Longs who want physical delivery must notify the exchange. The COMEX then has the delivery period running through the end of March to fulfill those obligations. Normally this is a non-event. 2 to 5% stand. The COMEX delivers. Market moves on. Nobody cares. But January 2026 saw 49.4 million ounces delivered, 7.27 times the 2024 level, 30 times historical January averages. In one single week in January, 33.45 million ounces were withdrawn from COMEX vaults. 26% of registered inventory pulled in 7 days. And on January 7th, JP Morgan issued 99% of all deliveries in a single day. One bank, 99%. When one institution controls the delivery mechanism of an entire commodity market, that is not a market. That is a single point of failure dressed up as a market, and we are 16 days from testing whether that point of failure holds. If we're conservative and say 25% of March open interest stands for delivery, that's 107 million ounces demanded against 87 to 103 million available. No margin for error. If delivery demand hits 50%, we're looking at 213 million ounces. If it hits 70%, matching what we've seen recently, 298 million ounces demanded from vaults that might hold less than 90 million by then. There are only 3 possible outcomes. They deliver metal that doesn't exist, which is impossible. They cash settle contracts at a premium, which is a public admission that paper silver was never fully backed, or they declare force majeure, which means the exchange itself admits it cannot honor its obligations. Every single one of those outcomes breaks something, and whatever breaks will not be put back together quietly. I'm watching 3 things every single day between now and that date. First, COMEX registered inventory. It updates nightly at 9:30 p.m. Eastern on the CME website. If we drop below 95 million ounces before February 27th, we are in critical territory. We are tracking toward exactly that. Second, Bitcoin. If Bitcoin breaks below 65,000, expect more selling pressure across risk assets, including silver. If it reclaims 75,000, that's the all-clear signal. At 69,000 right now, we are sitting on a knife's edge. This could break either direction. Third, the Shanghai premium. If it stays above 10%, the physical market is confirming that the paper sell-off is meaningless noise. If it collapses toward zero, that tells us real pressure is relieving. Right now it's holding at 13 to 14%. The physical market is looking at the paper market's 4.7% decline today and saying, that's cute, we're still charging 14% more for real metal over here. And there's one more thing I'm watching that I haven't mentioned yet. February delivery notices over the next few days. If we see acceleration, if the pace of February deliveries picks up in the final weeks, that tells us something deeply important. It means traders are front-running March. It means they don't trust that metal will be available when March delivery arrives. They're pulling deliveries forward, grabbing what they can now. That would be the canary in the coal mine. And if that canary stops singing, you need to be paying very close attention. So here's where we are. Silver is falling today. It might fall more tomorrow. Friday's CPI will determine whether we bounce or bleed into the end of the month. But underneath the price, underneath the charts, underneath the headlines and the panic and the margin calls, the physical market is telling a story that the paper market cannot suppress forever. COMEX registered inventory just crossed below 100 million ounces with 16 days until the most critical delivery month in decades. Institutions are accumulating 33 million ounces in a single day, while retail panics and sells. Shanghai is holding a 14% premium over Western paper. China reclassified silver as strategic and restricted exports. The U.S. Mint cannot supply its own coins. Lease rates are at levels not seen in a generation. Dealer premiums are at historic extremes. And the structural deficit enters its 5th year with no geological solution on the horizon. The squeeze doesn't happen when everyone is bullish at $121. It happens when sentiment is broken, when weak hands have been shaken out, when overleveraged positions have been liquidated, when the last person who was going to sell has sold. That's when supply meets a wall of demand with no inventory to fill it. I don't call bottoms. Nobody does. But I watch data, and the data says the lower this goes now, the more violent the move when supply cannot meet demand. Physical premiums at 110%, lease rates at 8%, drainage at 785,000 ounces per day, delivery rates at 98%, Shanghai premiums at 14%, institutional inflows at record levels. These aren't opinions. These aren't theories. These are numbers, published numbers, verifiable numbers. And the numbers are saying something is coming, something that the paper market is not prepared for, something that 16 days from now will either confirm or deny everything I've just told you. Friday's CPI at 8:30 a.m. Eastern is the next catalyst. February 27th is the main event. And the trap that's being set right now, while everyone watches the price and misses the structure, is the kind of trap that only springs once. And when it does, there won't be time to get positioned. If this analysis helped you see through the noise, hit subscribe. Drop OG John in the comments. Share this with anyone who needs to understand what's actually happening underneath the surface. Because by the time the surface catches up to the reality I just described, the opportunity will already be gone. Stay sharp. OG John, signing off.